Okay, let's dive right into this explainer. Today, we're unpacking a really fascinating thesis about why the broader market might be, well, completely misreading Bitcoin. If you look at the screens on Wall Street, you'll see it being treated just like a risky high-beta tech stock, right? It's seen as this gamble that goes up when people are feeling brave. But the analysis we're looking at today argues that this narrative completely misses a massive fundamental shift, the literal birth of a foundational monetary asset.
You know, there is a massive gap right now between Bitcoin's global fame and actual genuine market comprehension. The name saturated the planet years ago. Everybody knows the word. But true understanding, that is running very, very late. And the source material highlights that a significant generational opportunity currently lives exactly inside this enormous gap. It's the gap between how famous the asset is and how little the broader market actually understands its mechanics. For instance, look at what happens around that $60,000 mark. When the price recently dipped below it, traditional finance analysts just panicked. They started screaming the word risk to settle the argument and write it off. But according to the research, they're missing the big picture entirely. The source posits that Bitcoin is actually a monetary asset clawing its way up from absolute zero. I mean, it started as an experiment on a mailing list, and now it's monetizing its way toward becoming global reserve collateral.
All right, let's jump straight into part one, the grand misunderstanding.
Traditional analysts often arrive at Bitcoin carrying the exact same checklist they use for corporate stocks. It's like they're walking around like building inspectors with clipboards, asking to speak to whoever's in charge. They're looking for cash flows, they're hunting for a management team, and they fully expect a friendly central banker to just show up at 3 a.m. with a fire hose of fresh liquidity if things go wrong. But the source argues they completely miss the reality of decentralized money. There's nobody in charge, and when it falls, there's absolutely zero intervention to catch it.
So when these analysts ask to speak to the manager, they're met with a completely alien concept. The analysis points out that unlike corporate managers, the ones who make promises, or discount cash flows, or excuse soft quarters because of macroeconomic weather, Bitcoin's manager is pure math. And math doesn't come to the front desk. Math doesn't take meetings for bankers, it doesn't get fired, and it certainly doesn't have to win an election.
You see this strict, incorruptible management best in the 21 million hard supply cap. It's a ticking clock. It issues units on a strict schedule that absolutely nobody can lobby against. It literally doesn't matter if you're a massive sovereign wealth fund or a kid in Vietnam with a smartphone. The supply of Bitcoin answers to arithmetic and arithmetic alone. The thesis suggests it is, for sure, the first truly free market.
Moving right along to part two, the ETF illusion.
Remember when spot ETFs were approved? The traditional finance industry threw a massive party. They decided Wall Street had finally figured Bitcoin out, but the source argues they drew the exact wrong conclusion. To quote the analysis directly, an ETF is a feeding tube. If the system can't eat the steak, somebody has to blend the steak into a slurry. The traditional system didn't actually learn how to swallow the asset itself. Wall Street just built a familiar doorway, shaped exactly like their own rules so they could charge fees. The patient on the feeding tube never actually learned how to cook.
I just love the imagery used here. For years, much of the traditional financial establishment stood outside the house of Satoshi, hissing that the asset was a scam or poison or just a toy for criminals. But the moment they located a legal doorway to charge an annual fee, the messaging flipped overnight. The very institutions that called it a scam are now perfectly happy to manage your exposure to it.
And this is where the rubber meets the road for investors. With an ETF, you're accepting counterparty risk, you completely lack the ability to self-custody or withdraw the asset, and you're paying an annual management fee for the privilege. On the flip side is the reality of holding real Bitcoin. So the research asks a pretty critical question. Why would you accept counterparty risk and pay a fee for an asset that ultimately underperforms simply holding your own keys?
That brings us to part three, the volatility toll booth.
Look, when drawdowns of 50% or more hit, bears see those red candles, note the liquidations, and scream that it's just a risky gamble. And let's be honest, the pain of seeing a portfolio drop sharply over a long weekend, that's very real. But the analysis suggests jumping to the conclusion that the road has run out is fundamentally flawed.
What critics might be missing is the true definition of what we're actually watching. The source suggests we are watching a primate species, us, negotiate the value of a brand new form of money live, with no referee on the field. Of course it swings wildly. You've got 7 billion people arguing in public with their actual money about what this invention is worth. The price is simply the running scoreboard of that massive global argument. Honestly, complete stability right now would be the strange part.
So volatility, the research argues, is simply the toll booth you pay to travel down this highway. You pay in fear, and sometimes you pay in capitulation. But the bears mistake this toll booth for the end of the road. The thesis is that the road has never run out. Every single major drawdown is actually doing vital work with the lights off. It's quietly transferring ownership from those who are just renting their positions to people who intend to hold it for life. And on the far side of that toll booth, the liquidity deepens and the network hardens.
Let's explore Part 4, Hardening into Global Collateral.
Just like water changing states, the source describes Bitcoin as constantly evolving. For most of its life, it was in a gas era, diffuse, held in the hands of everyday retail individuals looking for a savings technology to opt out of inflation. But what's happening right now is condensation. The asset is settling heavily into corporate treasuries and ETFs, and it's actively moving toward hardening into solid collateral. I mean, we are now hearing serious macroeconomic discussions use the phrase sovereign reserve. It is theoretically taking on the dense role of anchoring the financial system, much like gold did for centuries.
The story flashing on the Bloomberg terminals is that it's just a risk asset, but the underlying thesis of our source material is that Bitcoin acts as a monetary black hole. It is slowly, with infinite patience, repricing individual and corporate balance sheets around itself. When you strip out the daily volatility and look at the actual monetization of this asset, the analysis points to a gravitational pull that is actively absorbing the monetary premium from every other asset class in the world. You literally can't outrun it.
Finally, let's look at Part 5, Bridging the Understanding Gap.
So, what if you bought into the ETF illusion we discussed earlier? For those currently trapped paying high management fees in vehicles like GBTC, the source outlines structured solutions. Platforms like Swan RBX, for instance, offer a way to migrate from an ETF directly into real, self-custodied, on-chain Bitcoin. It avoids selling on the open market, seeking a tax-efficient outcome so investors don't trigger a massive capital gains event just to get their own keys. The goal, according to the research, is to stop the fee drain and take true ownership.
As we wrap up this explainer, I want to leave you with a final, really powerful thought from the source material. Short-term traders often think they're being brilliant, trading a risk asset during market turbulence. But the counter-thesis is that during a historic correction, they might actually be handing scarce, hardening monetary collateral over to entities that have absolutely zero intention of ever giving it back. The price corrects, sure, but the foundational thesis compounds. So the question the analysis leaves us with is this: are you going to let the noise of the toll booth distract you, or are you going to embrace what this source calls the greatest compounding monetary thesis in history? Choose carefully.